Obviously, we've seen a very sharp rise in crude oil prices since autumn 2010. At the IEA, we would argue that there's been a very sharp tightening in market fundamentals. We've had the Libyan crisis, the loss of 1.5 million barrels per day of supply, and fears about contagion within the MENA region, as well as concerns about what looks like runaway non-OECD oil demand growth, which has sustained prices at or above $100 per barrel. The bottom line is this year, our price assumption, and I would stress it is a price assumption, which is taken from the Brent future strip, it's around $20 per barrel higher than when we were doing this exercise both back in November, December time, and indeed back in June 2010. So we're working with a price assumption of just north of $100 per barrel. The futures markets and financial flows into and out of commodities clearly have a short-term impact on prices, but empirical research tends to suggest, firstly, that causality may flow from oil prices to exchange rates rather more than in the other direction. Secondly, that volatility is not demonstrably higher, if you look at volatility in the pure sense of the term, in 2011 than it was for much of the past decade. Commodities are inherently volatile, and particularly commodities that are so price inelastic as oil is. Our argument would be that you still have to look at today's and expected future fundamentals to get a reasonable idea of price direction, if not the absolute level of prices within the market. If we look at global oil demand, as I said, two scenarios: high GDP and relatively high levels of improvement in oil use efficiency, and that gives you oil demand growth of about 1.2 million barrels per day every year. Very clearly, the growth in oil demand is all coming from the non-OECD, from the emerging markets, and from China, Asia, and the Middle East, which together account for nearly 95% of net growth in oil demand over the forecast period. OECD refining remains a business under pressure. The bottom line is there's a tidal wave of new build capacity in refining in Asia and the Middle East, which is going to put utilization rates in the OECD under intense pressure between now and 2016. High prices and strong economic and oil demand growth can coexist for a while because of the inelasticity of oil to prices in the short term. Economic risks, however, remain skewed to the downside the longer we have $100 plus oil, and that should also ultimately spur greater efficiency gains within the oil economy going forward. Ultimately, this market is going to find a new equilibrium point. Very difficult to say at what price that will end up being for the short and medium term, but it will crucially depend on today's investment, both in new capacity for production and also continued investment in improving end-use efficiency.